we know health is also wealth. So let's pause this video and work these pull-ups!
Report on your taxes, deposit into a bank account, and use to build wealth through legal channels. It's transparent, documented, and part of the formal economy that governments can track and regulate. Black money, on the other hand, is income that's intentionally hidden from tax authorities and regulatory agencies. It comes from illegal activities, unreported business earnings, or money that's been deliberately kept off the books to avoid taxation and scrutiny. The distinction between these two systems shapes everything about how America's economy actually functions, and understanding the difference is crucial to grasping how wealth really works in this country. Let's start with white money, because that's what most people interact with every single day. White money is born the moment you receive a paycheck from an employer. That check goes into a bank account, and the bank reports that deposit to the Internal Revenue Service through various reporting mechanisms. Your employer has already withheld taxes from your salary, and at the end of the year, you file a tax return that documents exactly how much you earned. This complete documentation creates what economists call a transparent financial trail. Every transaction is theoretically traceable. When you use a credit card, when you make a bank transfer, when you invest in the stock market, all of it gets recorded in databases maintained by financial institutions and government agencies. The beauty of white money from the government's perspective is that it's incredibly efficient to regulate and tax. The system is designed so that money flows through documented channels, and the government takes its cut at multiple points along the way. White money also has another critical characteristic. It can be legally leveraged to create more wealth. When you deposit money in a bank account, that bank can lend it out to other people, and you earn interest on your balance. When you invest in stocks or bonds, you're participating in the legitimate capital markets where your money is used to fund businesses and government operations. Over time, through compound interest and investment returns, your white money can grow substantially. This growth is legal, predictable, and protected by contract law and regulatory frameworks. You can take out a mortgage on a house because lenders trust the documented nature of your income. You can get a business loan because banks can verify your financial history. The entire structure of modern American capitalism is built on the assumption that wealth will be accumulated through white money and legitimate financial channels. Now, black money operates on entirely different principles. Black money comes from activities that are either explicitly illegal or from legitimate businesses that deliberately underreport their income to avoid taxes. A drug dealer's profits are black money. An under-the-table cash payment for freelance work that doesn't get reported is black money. A restaurant that skims cash from the register and doesn't record those transactions is generating black money. Construction contractors who pay workers in cash without withholding taxes are creating black money. The common thread is that none of this income appears in any official financial record. There's no bank deposit, no tax return line item, no documented trail that connects the money to its source. The challenge with black money is that while it's profitable in the short term, it creates massive problems for anyone who wants to use it. If you have $1 million in black money hidden in a safe, you can't simply deposit it into a bank account. Banks are required by law to report large cash deposits, and they're trained to flag suspicious patterns. Financial institutions use a process called Know Your Customer verification, and they're supposed to ask questions about where large sums of money come from. Depositing black money into a legitimate bank account is how most people get caught. It's called structuring, or making deposits specifically designed to avoid triggering reporting requirements, and it's a federal crime all by itself. So black money stays in cash form, hidden in safes, buried in yards, or moved through informal channels that don't leave paper trails. This creates what's called the underground economy or the shadow economy. In America, economists estimate that the shadow economy represents somewhere between 5 and 15% of total economic activity, depending on which studies you look at. That's hundreds of billions of dollars per year, flowing through channels that the government doesn't officially track or tax. Some of this shadow economy money comes from genuinely illegal activities like drug trafficking, human trafficking, and organized crime, but a substantial portion of it comes from otherwise legitimate businesses that simply choose not to report all their income. A plumber who charges you cash and doesn't report it on his taxes is participating in the shadow economy. A hairdresser working from home who doesn't register her business is part of it. These aren't necessarily criminal enterprises, but they're deliberately avoiding the formal financial system. One of the most significant problems with black money is that it can't easily be converted back into white money without drawing attention. Let's say you've accumulated black money through illegal activities or tax evasion. You want to enjoy that money, buy a house, purchase a luxury car, or start a legitimate business. The moment you try to make a large purchase with that money, you run into problems. Where did the money come from? How can you prove it's legitimately yours? If you try to buy a $500,000 house with cash, the seller's bank will require documentation of where that cash originated. They'll demand proof that you earned it legally. This is where money laundering comes in. Money laundering is the process of taking black money and converting it into white money, or at least making it appear to come from legitimate sources. There are three basic stages to money laundering: placement, layering, and integration. In the placement stage, you move the black money into the financial system. This might involve structuring, using cash-intensive businesses, or moving the money through casinos or informal banking systems. In the layering stage, you perform a series of complex transactions designed to obscure the money's origins. You might move it between different bank accounts, invest it in assets, convert it to different currencies, or conduct a series of seemingly legitimate business transactions. By the time you reach the integration stage, the money is supposed to look clean. It's been integrated back into the economy as apparently legitimate income from a business, an investment return, or some other legal source. The federal government combats money laundering through agencies like the Financial Crimes Enforcement Network, which is part of the Treasury Department. Banks and other financial institutions are required to file suspicious activity reports when they detect unusual transaction patterns. The government has established thresholds and red flags that trigger investigations. Large cash transactions, rapid movement of money between accounts, transactions that don't match someone's known income or lifestyle, and involvement with countries known for financial crimes all raise suspicions. Despite these safeguards, money laundering still happens on a massive scale. The United Nations estimates that between 2 and 5% of global GDP is laundered annually, and that's just the money that's detected or estimated. The actual figure could be much higher. One common method for converting black money into white money is through seemingly legitimate businesses. A nightclub or restaurant is perfect for money laundering because they handle large amounts of cash daily, and the actual revenue is difficult to verify precisely. If you own a nightclub that legitimately makes $100,000 per month, you could easily report $150,000 in revenue and integrate an additional $50,000 of black money into the reported income. Because the business already handles cash, and cash transactions are difficult to audit perfectly, the excess money blends in. The same applies to laundromats, cash-based retail businesses, casinos, and any other enterprise where the volume of cash makes precise verification nearly impossible. These businesses become vehicles for converting black money into white money that can then be banked, invested, and used legally. Cryptocurrency has emerged as a newer tool for money laundering in the 21st century. Bitcoin and other decentralized cryptocurrencies don't require the same reporting and verification that traditional banking does. You can theoretically exchange black money for cryptocurrency in an untraced transaction, hold it in a digital wallet, and then convert it back to dollars through legitimate cryptocurrency exchanges. The anonymity is never complete because cryptocurrency transactions are actually recorded on a public ledger called a blockchain. But the connection between the wallet and the person controlling it can be harder to trace than traditional bank transactions. Regulatory agencies are becoming increasingly sophisticated at monitoring cryptocurrency exchanges and flagging suspicious patterns. But the speed of innovation in this space means that money laundering techniques using cryptocurrency continue to evolve faster than enforcement catches up. The consequences of participating in black money systems differ dramatically depending on your role and the scale of your activities. Someone who accepts cash payments and doesn't report them might get away with it for years, paying somewhat lower taxes and hoping they don't get audited. But if they're caught, they face serious penalties. The IRS can assess back taxes, apply penalties ranging from 20 to 75% of the unpaid tax, and potentially pursue criminal charges. Criminal tax evasion carries penalties of up to 5 years in prison and fines up to $250,000 per count. For serious money laundering involving large sums or connection to organized crime, federal sentencing guidelines can result in prison sentences of 10, 20, or even 30 years. Beyond legal consequences, black money creates lifestyle complications that white money doesn't. If you're accumulating wealth through illegal activities, you can't openly display that wealth without raising suspicions. You can't brag about a business that doesn't exist. You can't explain an expensive car or house to your neighbors. You're constantly worried about financial audits, law enforcement investigations, and betrayal from associates who might cooperate with authorities. The psychological stress of maintaining this secret financial life is substantial. You can't trust banks with your money, so you have to physically safeguard it, which makes it vulnerable to theft. You can't easily access it for emergencies. You can't invest it in ways that generate legitimate investment returns. In many ways, black money is trapped money. It's wealth that exists, but can't be fully utilized without constant risk. The wealth inequality in America is substantially driven by the differential ability to accumulate and leverage white money versus black money. Someone earning a legitimate middle-class income through employment can take out a mortgage, get business loans, invest in retirement accounts that receive tax-advantaged treatment, and build wealth that compounds over decades. Someone generating black money from illegal activities might accumulate substantial sums quickly, but they can't leverage that money through legitimate financial institutions. They can't get the compound interest gains that legitimate investors receive. They can't pass their wealth to their children through legal trusts and inheritance structures. They can't participate in the stock market. In practical terms, black money generates diminishing returns compared to white money, even though it might seem more profitable in the short term. The impact on communities is significant as well. Neighborhoods where substantial black money economies exist often lack the tax revenue needed for quality schools, infrastructure, and services. Drug dealers might make enormous sums, but that money doesn't stay in the community to improve it. It gets exported to other regions, or it gets spent on consumption rather than investment in the community's future. Meanwhile, legitimate businesses that play by the rules are at a disadvantage because they're paying taxes and competing against businesses that aren't. A legitimate restaurant pays employment taxes and business taxes, while an underground restaurant skimming cash has a cost advantage. This creates perverse incentives that can drive even honest businesses to consider participating in black money systems just to stay competitive. Government agencies have become increasingly sophisticated at detecting and combating black money systems. The Financial Crimes Enforcement Network uses artificial intelligence and machine learning to analyze patterns of financial transactions across the entire banking system. When your financial behavior deviates from your established patterns, algorithms flag it. If you suddenly start making large purchases that don't match your documented income, investigators notice. The integration of databases across federal agencies means that information from the IRS, the DEA, the FBI, and state law enforcement can be combined to build comprehensive cases against serious money launderers. International cooperation has improved as well, making it harder to hide money in offshore accounts or foreign banks, though challenges remain. There's also a substantial shadow economy of people who are trying to transition out of black money systems and into legitimacy. Someone who spent years making money through illegal activities might eventually want to go straight, start a legitimate business, and stop looking over their shoulder. But re-entering the white money system comes with real challenges. They need to explain their past income, which is difficult without documentation. They might struggle to get business loans or credit because their financial history is spotty. They might face suspicion from banks and financial institutions. In some cases, federal agencies will approach people known to have been involved in black money systems and offer them opportunities to come clean, pay back taxes plus penalties, and avoid prosecution if they stop illegal activities and properly report future income. These programs recognize that it's sometimes more efficient to bring people into the formal system than to prosecute them. The digital transformation of the American economy is gradually making it harder for black money to thrive. As more transactions move online and become automatically documented, as payment systems increasingly require identification and verification, as surveillance technology becomes more pervasive, the opportunities to operate in the shadow economy shrink. Cash is becoming less relevant in everyday commerce, which makes it harder to hide unreported income. A business that operates almost entirely through credit card and digital payments creates an automatic financial record that's much harder to falsify than a cash business. In theory, this should reduce black money significantly over the coming decades, but in practice, new methods for hiding income always emerge. The evolution of financial crime keeps pace with the evolution of law enforcement. The relationship between black money and white money reveals something fundamental about American economics and human nature. Most people aren't purely motivated by legality. They're motivated by incentives. If the tax burden is perceived as too high, if regulatory requirements are seen as excessive, if the benefits of participating in the formal economy are unclear, people become more willing to operate in the shadow economy. Conversely, if the formal economy offers clear advantages, if financial institutions are trustworthy, if the legal system is transparent and fair, people prefer to operate with white money. Countries with lower levels of corruption, higher trust in government institutions, and more efficient financial systems tend to have smaller shadow economies. Countries with high corruption and weak institutions have much larger black money sectors. Understanding the distinction between black money and white money also helps explain some of America's ongoing debates about taxation, regulation, and economic policy. When politicians advocate for lower taxes, one argument they make is that lower tax rates reduce the incentive to engage in tax evasion and black money activities. If people can keep more of their legitimately earned income, they're less motivated to hide income from the government. Conversely, when agencies advocate for stricter financial regulations and more aggressive enforcement, they argue that these measures deter people from entering the black money economy in the first place. The actual empirical evidence suggests that both arguments have some merit, but neither one is comprehensive. Tax rates matter, but so do cultural attitudes toward taxes, enforcement effectiveness, and the benefits available to people in the formal economy. The distinction between black money and white money is ultimately about trust, documentation, and access to formal financial systems. White money flows through institutions that require transparency and create permanent records. Black money operates outside these institutions in cash and informal networks. The advantages of white money are substantial: legal protection, access to credit, investment opportunities, and the ability to build generational wealth. The disadvantages of black money are equally substantial: legal risks, inability to leverage assets, lifestyle restrictions, and diminishing returns over time. The American economy's growth and stability depend on most economic activity flowing through white money systems. When significant portions of the economy operate through black money channels, it creates inefficiency, reduces tax revenue, and ultimately slows economic growth. Understanding this distinction is key to understanding not just how money works in America, but how society itself functions. The choice between black money and white money is really a choice between short-term gain with long-term risk versus slower accumulation with legal security and genuine wealth building. The smart money has always chosen white, and that's why understanding this difference matters for your financial future.
We know health is also wealth. So let's pause this video and work these pull-ups.